Hey everyone, we have Blake here, product manager at ZeroX. He'll be doing a talk on growing DeFi with the help of professional market makers, and I'll let him take it from here.
Awesome. Hi guys, I'm Blake Henderson. I'm a product manager at Dystopia Labs focused on liquidity. Just to give you guys a little bit of context, ZeroX is a liquidity protocol that enables the trustless exchange of assets on the Ethereum blockchain. And our core product offering today is the ZeroX API, which is a decentralized exchange liquidity aggregator that taps into both on-chain and off-chain liquidity to get users the best price trade across DEX. And my context with market makers is that I onboard market makers onto our system, so I know a lot about what they're thinking about. So with that, let's talk a little bit about growing DeFi with the help of professional market makers. Jumping right into it, we have a pretty simple agenda. I'm going to first talk about the state of DEX and DeFi today. Second, I'm going to talk about how is DEX supporting DeFi's growth well today. Third, we're going to talk about some of the shortcomings of DEX that are holding DeFi back. And finally, we're going to talk about one particular way to solve some of DEX shortcomings in order to allow DeFi to continue to grow quickly. So jumping right into it, this is state of DeFi. 2020 has really been a blockbuster year for DeFi. We're looking here at a chart of total value locked USD in DeFi. You can see that a year ago, it was about $500 million, and close to today, it's at $11 billion. We've actually seen total value locked in DeFi has grown 20x in just 1 year. Pretty incredible growth, something to be really excited about. Going along with that, the state of DEX, 2020 has been an even bigger blockbuster year for DEX. So what you're looking at here in this chart is total USD DEX volume that's traded in 2019 is the blue bar, and then 2020 is the red bar, and this is by month. And you can see that the red bar is significantly larger than the blue bar. DEX is currently trading more volume per week, so $2.5 billion that was traded in all of 2019. So we're actually looking at about 50x growth in DEX volume in just 1 year. And this is not a coincidence. The growth of DeFi is fueled by or limited by DEX. So DeFi and DEX are deeply linked with each other. Without DEX liquidity, DeFi users can't move money freely enough between assets to build a robust alternative financial system. And that's what we care about, right? We care about building this robust alternative financial system. So better pricing for DEX trades means users never have to exit DeFi to trade on centralized exchanges. They can do all of their trades directly through the decentralized exchange. So essentially here, stronger decentralized exchanges mean stronger DeFi overall, and that's what we care about. So I'm going to be talking a lot about, how DEX enables DeFi and what's going well and what's not. So first off, DEX has been doing really well. How has it been supporting DeFi's growth so far? The incredible growth of DeFi wouldn't have been possible without key upgrades across DEX in 2020. So I'm going to talk to you about two of those. The first is the deepening of DEX liquidity in automated market makers. So this is automated market makers like Uniswap, Curve, and Balancer. And the second key upgrade is the rise of DEX liquidity aggregation through ZeroX API, through 1inch, through Paraswap, and we'll talk about that a little bit as well. These two upgrades have really allowed trades that would have occurred on centralized exchanges before, or maybe not at all, to actually move to decentralized exchange. And that's why we've seen sort of this growth of 50x on decentralized exchange. So let's dive in first on, this is something that's been going really well in decentralized exchange, the deepening of DEX liquidity in automated market makers. So what you're looking at here in this chart is total value locked in US dollars in Uniswap. And you can see that as of a year ago, I think the number is $11 million, something like that. And as of right now, there's $2.7 billion in Uniswap. This is just one of the automatic automated market makers that's available. A lot of this, just one of the many automated market makers available. There's also Curve, which has unlocked really powerful stablecoin trading. Balancer has allowed new pricing strategies that are not just 50-50 like Uniswap. And Uniswap's V2 has really become the go-to destination for new token teams looking to bootstrap liquidity. You can add any token and you can make it liquid immediately. And the innovation in these protocols, as well as the kickoff of liquidity mining, has led to a huge amount of capital being put in these automated market makers. And that's incredible for users of decentralized exchanges because more capital in AMMs means deeper liquidity, which means better pricing. And better pricing means more people can use decentralized exchanges. The second great thing is DEX liquidity aggregation and smart order routing. So back to this idea that there's been so much capital put into all these different automated market makers, that means better pricing for users, which is really exciting. But to get the absolute best price, you would need to check several different applications. You might go to the Uniswap front end, you might go to Balancer, you might go to Curve, and that's difficult for the user. Instead, this idea of DEX liquidity aggregation and smart order routing means it allows users to search through all DEX liquidity sources and combine liquidity from multiple sources in order to fulfill a single trade. And this all happens through a smart contract that does that routing. That essentially means no more searching for the best price that's available across all of these different liquidity protocols. And it means much better pricing for larger fills because you can fill through multiple sources at the same time. And so what you're seeing here in this visualization is it's just showing the 0x API is one of these DEX liquidity aggregators. And it's showing that it's looking at pricing from multiple different sources, and it's dynamically changing what the order will be for the user based on the pricing information that it's getting from these sources. So summary of what's going well, the deepening of DEX liquidity in AMMs and the rise of DEX liquidity aggregation have made DEX much more economically attractive to trade on. Decentralized exchange now beats centralized exchange for both bootstrapping new tokens, trading long tail pairs, and stablecoin trading. I don't think we're talking about this enough. It's a really, really huge deal. And DEX's market share is growing because it is now quite economical to trade on DEX for lots of different use cases. And so I think decentralized exchange used to be way less than 1% of all trading volume, and it's actually been growing pretty significantly. As you saw, it grew 50x, but it's actually growing against centralized exchange as well. So with that, I want to talk about a few of the shortcomings of DEX that I believe are currently holding DeFi back. Most crypto trading actually happens through just a small amount of pairs. And DEX has had a hard time consistently supporting competitive price for medium and large size trades for major pairs when compared against centralized exchange. So I'm talking about pairs like ETH USDC or BTC or WBTC against USDC. Those pairs do more than the next 10 pairs combined. These pairs matter a ton. And if DEX can compete with centralized exchange for these particular pairs, a much larger percentage of market share will move to DEX. And because of that, decentralized finance will be able to grow even faster. People won't need to exit the system in order to get that good pricing and to have less friction in those trades. So this is a really important thing for us to solve. Inherently, why do DEXs struggle with these trades today? The short answer is they don't necessarily struggle with these particular trades. It's just that the bar for these trades is incredibly high. So centralized, because so much volume goes through just a few of these pairs, centralized exchanges have focused on them very, very intently. Trading major pairs on the best centralized exchanges can cost 5 to 25, I have here 15 to 25 basis points, including trading fees and slippage. Especially if you're a large trader, you get discounts on trading fees, and that can drive your price down for these trades. And centralized exchanges can support this because their platforms support market making strategies that rely on speed. Market makers can update their prices really quickly. They have these really robust backends that sort of allow the trading of these assets in a way that traditional finance trades most other assets. So it's kind of based on historical technical achievements that we've already made. However, when you think about decentralized exchange supporting these trades, the market making risk of these trades on DEX is just too high with DEX's current tool set. And I'm going to talk about why. I'm going to talk about automated market makers, and I'm going to talk about DEX order books, which are the two major tools for market making on DEX today. So when we think about automated market makers, why do they come up short on these ETH USDC trades or these other major pair trades that make up a lot of the volume? The short answer is impermanent loss. You guys hear about this term a lot. It essentially means that, there's one of the greatest strengths of automated market makers is that they're available to trade with anyone at any time. So they're in both sides of the market at all times. But one of the problems is that if AMMs provide too much of their liquidity close to the current market price, and the price moves significantly in either direction, their LPs lose a lot of money, and we call that impermanent loss. So instead of doing that, to protect themselves as much as possible from volatile markets, AMMs usually choose to be more conservative with their LP money and therefore charge higher fees. So a really good example is Uniswap today always charges a 30 basis point trading fee, and then they add on slippage based on the size of your trade. So if you're trying to compete with a centralized exchange that offers 15 to 25 basis points on a specific trade, it's really hard when the largest automated market maker charges 30 basis points as a minimum fee in order to protect its users from, its LPs from impermanent losses. Second, DEX order books have a slightly different problem when we talk about supporting these medium and large size trades. As I was talking about before, market makers manage their risk on centralized exchanges through speed and hedging. So they can actually update the pricing of their orders in real time very, very quickly. So if the price changes 1 second from now, they can update they can cancel an order and they can re-put another order on the book. On decentralized exchange, market makers have to deal with slow settlement speeds of Ethereum. Ethereum block times are 13 or 14 seconds, and they have to make orders available for multiples of that 13 or 14 seconds in order for their orders to actually be usable by traders. So when they offer orders to users, they can't update their price very quickly, say something on the order of maybe 2 minutes instead of that 1 second on centralized exchanges. And when they can't change their prices quickly, that means that they can't price as competitively, because if the price changes against them during that 2 minutes, an arbitrager can come in and fill their order, and they would lose money on that. So essentially, automated market makers and DEX order books both deal with this issue of volatile markets and arbitrage that goes along with volatile markets. Essentially, if the price changes and you're willing to trade with anybody, arbitrage bots come in and take orders when your orders become mispriced. So what's the big solution here? There's actually 3 different pathways that you can go down. The first is build more capital efficient AMMs that can price more aggressively and be profitable through market fluctuations. Lots of people are working on this problem. It's a really hard problem to solve. There's lots of interesting ideas around there about taking volatility into pricing and things like that. The second is upgrading DEX order book technology to lower risks for market makers. 0x has actually worked on this problem for a long time. It's also a really hard problem to solve, just because DEX order books are currently built on top of Ethereum, which has this slow block time. So there's an inherent constraint there. Those are both upgrading tools that we already have. I'm going to talk a little bit more about adding a new tool to the tool belt. So enabling a new market making behavior that lowers risk for market makers in volatile markets. So this new methodology to offer liquidity is not really new. So 0x spent the last 8 months essentially building out a request for quote model. Request for quote is sort of a fancy name for OTC. It's based on and looks a lot like OTC trading through an API. OTC trading has existed on centralized crypto markets for a really long time. Actually, a lot of volume went through OTC before a lot of it went through exchanges. And large trades, a lot of them still do go through OTC. But kind of the differential here is 0x built this new request for quote model on top of the DEX aggregation that it already had. And we built it with market makers who were asking for very specific protective features. And we kind of built those into the product. So this is the first time that we're sort of unrolling it out to the DEX market. We have a few people using this product. I'm going to talk a little bit more about why it enables people to support these medium and large trade sizes that DEX really needs in order to support DeFi's growth. So at a very high level, this is a picture of what's happening and how the request for quote model is built into 0x's system. Here, the user in step 1 is requesting to buy or sell from the 0x API. In step 2, the API is actually looking at all on-chain sources of liquidity. So it's looking at Uniswap and Balancer and actually 10 other sources, as well as off-chain order books. But it's also, and this on the bottom of the diagram, you can see it's also pinging market makers delivering custom quotes directly. So it actually passes on the information about the user. It says they're coming from this application. This is the user's Ethereum address. This is what they want to buy. Why don't you quote for this particular user? Once the API has all this information from on-chain sources and all of this information from requests for quote market makers, it actually does that DEX aggregation and smart order routing. It essentially slices and dices together the best possible priced order from all of that information for the user. And then step 5 is it actually passes it back to that particular user. It's just a call data that they can submit to the Ethereum blockchain if they want to fill that trade. So you can see that the request for quote system builds into this API experience pretty natively. The user doesn't see any of the complexity happening behind this API. All they see is step 1, they request liquidity, and step 5, they get a response from the API with the best price. So I want to talk a little bit more about why this system was built and what it means for market makers. We talked a little bit about how both AMMs and DEX order books have this problem with arbitrage, especially in these highly volatile, quick to update markets. So the RFQ system is specifically built to lower risk for market makers, providing liquidity to users. I want to talk a little bit more about how it does that. And the idea here is to eliminate the arbitrage that would happen when your orders become mispriced because they're only available to the user that you wanted to offer liquidity to. There's a big thing for market makers, essentially maximizing the ratio of good order flow or retail order flow to the toxic or arbitrageur flow that they want to avoid in centralized markets. That's avoiding high frequency traders and hedge fund type traders. On DEX, it's avoiding these arbitrators. So how does the system do this? RFQ liquidity is only available to known applications through the 0x API. Essentially, our bots are not welcome. So if MetaMask asks for a quote from the 0x API, we happily return, all these market makers respond and we happily return that pricing to them. If an ARB bot asks, they don't get access to the same RFQ liquidity from market makers. That blocks about 95% of the arbitrage, maybe 99% of the arbitrage that would be coming through. But there's sort of a second step here as well, which is users requesting RFQ liquidity through the 0x API provide their Ethereum address. And that's super important in that, one, it allows the market maker to customize pricing by risk so they can see where the flow is coming from. So let's say it's coming from the MetaMask front end. and this is a retail user who I'm interacting with, I can quote a really good price for this particular person. Also, because of the way the 0x protocol works, they can actually provide an order that's only fillable by that one user. So if an arbitrage bot happened to find that order, they couldn't actually fill it. It's only fillable by the person who submitted their Ethereum address here. And again, all of these features are built so that there's very, very little arbitrage of market makers, which means they can offer much better pricing to users. What does RFQ mean for 0x API users? It's actually really simple. It's just better pricing, especially for medium and large trade sizes. As you wouldn't be surprised, professional market makers often provide better pricing than automated market makers. When they do that, 0x API users get a better price than those automated market makers. And when an automated market maker provides a better price, 0x API users get that price from that source. So it's really simple. Adding another good source of liquidity means better pricing for 0x API users. And finally, what I'm really excited about, what does RFQ mean for the future of DEX and DeFi? So DEX already beats centralized exchange for long tail pair trading and stablecoin trading. Again, that's a really big deal, and that's helped propel DeFi to where it is today. DEX has historically had a hard time supporting these competitively priced medium and large trades for major pairs where a lot of the trading is happening. So ETH USDC, WBTC USDC, that's blocked DeFi from even faster growth, because if you're trading $50, $100, $150,000, you'd probably go to a centralized exchange to do that in some instances. Now, with RFQ as another tool, it allows professional market makers to bring all the liquidity that they're offering on centralized exchanges to DEX markets. They're not paying fees to provide that liquidity. There's no maker fee. They're just quoting directly to the end user. And it's a tool set that they know how to use because they've done OTC trading before. It's a simple tool set that cuts out arbitrage and allows them to add this liquidity. So very simply, if you add liquidity from professional market makers plus liquidity from all of these amazing automated market makers plus DEX aggregation and smart order routing, you essentially get better prices to trade on DEX than on centralized exchanges for all pairs. And I'm making a big claim here. DEX markets are going to be more liquid than centralized exchanges. This is going to happen. This is why you see centralized exchanges paying attention to decentralized exchange. And RFQ is one of the tools that's going to help us get there faster. And again, at the end of the day, why does this matter? DeFi will not be blocked by the economics of trading on DEX. It'll actually be cheaper to trade on DEX than it is on centralized exchanges, and therefore can continue to grow. And there's less friction to trade, which allows a lot of new use cases to pop up. So I don't want to pretend like there are not still problems to solve. UX and scaling, both those things are being worked on. But I'm very hopeful for the future and excited to be supporting it with this particular tool set that we're offering to professional market makers to make DEX stronger and therefore DeFi stronger. So coming to the end of my talk, I want to encourage you to reach out if you're a professional market maker interested in trading on DEX, or if you're a DeFi application that wants to access all DEX liquidity and proprietary RFQ liquidity through one simple API call. Happy to talk to you about that in detail. I'm available at Hendo Ventures on Twitter and also in the 0x Discord. So with that, I want to turn it over to you guys to ask any questions that you have. I think I see one question here in the chat at the bottom, so I can start with that one. What are the requirements for market makers to provide quotes? Yeah, that's a great question. So we work directly with a lot of these professional market makers, and we help onboard them to the system. You have to be approved by the 0x team, but all that means is that essentially you can run our infrastructure effectively. So there's a full set of documentation that you can follow on our website in order to get a better understanding of how all the nitty-gritty details of how this works. But the basic requirements are that you need let's say $100,000, $50,000 to $100,000 of capital, and you have to be willing to run a server that responds to requests from the 0x API. Hopefully that answers your question. If not, and you have follow-ups, let me know. It looks like there's also one other question here. It says, do you know if DEXs are looking into obtaining licenses so that they can have fiat on and off ramps? Great question. DEXs are definitely thinking about fiat on and off ramps. I'm not sure what licensing they need to do it. I actually think they might be able to do it without licensing, but I've heard lots of good news about DEXs thinking about this in more detail. 0x has definitely thought about adding this into our trading application, Matcha. Third question here, do you have any planned solutions to mitigate the crazy gas prices we're experiencing? Something similar to gas token or Chai, perhaps. This is a great question. One of the things that's been blocking DEX trades from happening is just that it's really expensive in order to pay for gas prices. So 0x team has used gas token on the back end in order to help make trades through the Matcha platform cheaper. We don't currently support the Chai gas token of users burning it on the front end, just because we think that it's kind of a complex thing that only more experienced users would be able to use. That being said, we are re-architecting all of our smart contracts and all of our trading functionality in order to make our DEX liquidity aggregation as cheap as humanly possible to drive down prices for these particular trades. The other thing we've looked into doing is, if you guys know about meta transactions, we've looked into sort of baking the cost of the transaction into the total price and having the platform potentially kind of pay that fee for you. Do you guys have any other questions that I can help answer? I think one of the things I can talk about as well is just like this system is already in production. It already has several market makers onboarded onto it. It's doing millions of dollars a week already through requests for quote system. It's supporting up to 30 or 40% of some of the pairs that are running through the 0x API. So this is not something that we're planning to do. This is something that is already in production and is already supporting millions of dollars of volume on a weekly basis. So this is kind of a fun opportunity where we've spent a lot of time to build this out, but it is coming to fruition, and it is validating what all these market makers were saying about their experience.
So I have a question regarding market makers. So
Sure.
when you do talk to them, what are some very common questions that you encounter? Because I'm sure like they scope out a lot of different projects, and I'm just curious what they are thinking about when they evaluate.
Yes, that's a great question as well. I do talk to a lot of market makers. Usually the first question they have is just, what is the opportunity size on trading through your particular platform?
And how do you answer it as well?
Well, we actually have all of the data to show that. So I think we did 300 million through the 0x API in September. I think we're up to about 200 million in October so far. So we usually share those numbers. So like there's hundreds of millions of dollars that are going through this 0x API, and you can essentially quote on a large percentage of that volume. So that's usually the first question that they ask. The second is usually going into more detail on kind of how they're protected, or what are the details of how they're not going to get arbitraged in the system. And a lot of market makers also have questions about just trading on Ethereum. A lot of the market makers we talk to have been trading crypto on centralized exchanges. Trading on Ethereum is a little bit different. So a lot of them have nitty-gritty questions about where they need to hold funds and what that means for their particular business.
Cool, thanks. Do you have any closing thoughts before we transition to the next talk?
No, I just want to encourage people to reach out if they are interested in this. So the person who was asking about requirements, if you want to talk directly, I'm happy to talk about that. Yeah, I'm incredibly optimistic. As I said, my bold claim of this presentation is decentralized exchange is going to be more liquid than centralized exchange. I am incredibly confident in that, and I'm incredibly confident that we're taking the right steps to get there. So definitely want to leave you with that. And if you want to be part of a march towards enabling DeFi, definitely reach out and we can work together.
Awesome. Thanks, Blake. This was a really great
Awesome.
talk.